Hello and good morning, good afternoon or good evening, depending on where in the world you're joining us from. And welcome to this, the sixth part in an online webinar series that's been launched by the World LNG and Gas series. It's the sixth edition we're launching. All previous webinars are available on demand, lnghub.biz. You'll have access to all of the previous editions, as well as a multitude of other content that we've put out. It's an online free to join platform. You can actually network with members, so I'd recommend everybody joining if you have some time. Many of you will have joined a previous webinar we did a couple of weeks ago, also led by Pat and Andy, and it was looking at supply and demand, global supply and demand dynamics. It actually feeds quite nicely into today's topic of pricing. I was rewatching the supply and demand one, and actually at the end, the conversation was steered right on towards how LNG pricing and pricing moving forward within our business is going to play out. As such, we've got Andy and Pat back. They're going to be guiding you through the next hour, looking at and having this discussion. As per previous times, you've got a chat bar on the right-hand side of your screen. Please do feel free to write questions in for Andy and Pat. They'll try and handle as many of them as possible. The recording of this webinar will also be available online. Again, lnghub.biz. One other thing to mention, another new piece of content we've launched is the weekly wrap podcast. It's LNG Wrap. That's available on Apple Podcasts, and again, lnghub.biz. Okay, that's it for me. Over to you, Pat. Thanks very much. Enjoy, guys.
Thank you, Gurpreet, and welcome and hello to everyone who's joining us on the line today. As Gurpreet said, I'm Pat Roberts. I'm the Director of LNG Worldwide, and I'm joined here by Andy Flower, an independent consultant from Flower LNG, and we have several hundreds of you dialing in, so we're really looking forward to sharing the next hour or so with you. It is 8:30 at night in Singapore. It is 7:30 a.m. roughly in Houston, and it's mid-afternoon here in Europe. As Gurpreet said, this is quite a difficult topic for us that we want to sort of try to handle head on. And a lot of interest came from Andy and I's webinar a few weeks ago on supply and demand. And the topic for today really is LNG pricing dilemmas. We might find at the end of this, it's not a dilemma, it's a trilemma. There's so many options here for pricing and how you formulate and index LNG pricing in the future. I suspect no one who is on the line could easily have envisaged what I'm about to say next. Henry Hub, $1.75 per MMBTU, MBP $1.39, TTF $1.48, JKM $2.20, and 5 minutes ago, Brent trading at $36.50. A year ago, even perhaps 6 months ago, no one would have ever thought that we would see the prices that we see today. Our first webinar with Andy was on supply and demand, and we concluded that we are really in an oversupply situation, and all that's doing is really cascading prices downwards. And indeed, since Andy's webinar, prices have been falling steadily, reflecting oversupply. And the format for this webinar really is Andy will go through about 9 slides that he'll share with us on screen. And please send your questions in on the chat function. We will try to cover as many of those as we can during the live webinar. And the length of it is intended to be around 1 hour, but we will see what happens in terms of the sort of free flow of questions that are coming in. We've asked and challenged ourselves around 4 key points. The first one is the rationale for oil indexation for term LNG still relevant, or has it somehow been broken? We will ask, what's the appetite for buyers to buy on a Henry Hub indexation? And we'll ask about global price convergence of the type that I've just referred to before. Is it structural? Is it temporary? And last up, we have around 70 million tonnes of long-term LNG contracts, which will be expiring between now and 2025. Most of those contracts are signed up on oil indexation. What's the outlook for that in terms of recontracting Will buyers still want to buy on oil indexation or a change? Andy, over to you, please, if you wouldn't mind giving us your presentation first, and then we will head up with the question and answer session.
Okay, thank you, Pat, and good morning, good afternoon, or good evening, wherever you are. It was with some trepidation that I agreed to do this pricing webinar. LNG pricing is one of those issues we talk a lot about, but a lot of the information is not in the public domain. So we have to go on various reports, conversations, presentations at conferences and webinars to get some feel for what is happening. When I think back to, and the other thing, I'm going to focus a lot on Asia. First of all, it's the biggest market. It still accounts for about 70% of LNG imports. And secondly, Europe is the second biggest market, but really we now have trading hubs which are giving price signals based on gas. So in some ways, pricing in Europe is somewhat easier. You use TTF, you use NBP. When I think back to negotiating LNG prices in contracts in the 1980s and 90s for supply to Asian buyers, in one sense it was quite easy because you were going to link it to oil. All the contracts, all the long-term contracts were linked to oil. The price formula was A times the price of A times JCC plus a constant. And even the multiplier of JCC was pretty fixed. I mean, virtually everybody was using 0.1485 or a 14.85% slope. And a lot of the negotiations were about the constant. And when prices were renegotiated, I remember with the Northwest Shelf, for example, in price renegotiations in 94, 99, the whole debate was on the constant. The 14.85 times JCC remained unchanged. Of course, today we're in a very different world. First of all, the slopes are changing in the traditional oil indexed contract. And secondly, there are alternatives. US LNG has brought Henry Hub indexation into the mix. And you've got other prices out there, JKM now, which is gaining some credibility and reliability as a pricing index for longer term contracts. And you can also use the European indices, which has been happening in some contracts. So it's a much more difficult issue now, pricing. But having said that, oil indexation is still dominating in Asia. Something like 70-75% of LNG in Asia, according to the IGU wholesale price surveys, is being sold on an oil indexed basis. Spot LNG in Asia, which will often be priced against JKM or a fixed price, represents, in the case of Japan, about 12.5% of imports. So oil indexation still dominates in Asia. But it's leading to some big variations, big differentials between the price of the oil index price and the spot price as measured by JKM. And this first slide, what I'm showing on here, the black line at the top is JCC. The red line is the average price of LNG imported into Japan. And I see that as really a proxy for oil index prices around Asia, because if you look at the average prices of China, Taiwan, South Korea, they're very similar month by month to those in Japan. So it is the Japanese average price, but it's, I think, representative of the Northeast Asian market. And then in green is JKM. JKM for many years followed pretty closely the average prices. If you look back into the mid 2010s, at times JKM would be above the the oil index prices, other times below, but it wasn't not big differentials. Now we've got a very big differential. If we look at the latest month for which the official figures on Japanese imports are available, the average price of imports into Japan was 925 per million BTU. The average price in China was about 880, Korea was about 870. Well, we had JKM, as Pat said, running at about $2.20. So a big differential. JCC is beginning to come down, as you see on this graph. I got the figures for April, JCC for April, and it's equivalent to about $46 a barrel. So that will eventually feed through into into Japanese and other Asian oil index contracts by about August, and I'll come to that in more detail in a minute. Of course, we've now seen US LNG coming into Asia in fairly large volumes, and it's bringing a totally different pricing approach. Essentially, US LNG is cost plus LNG. The price is effectively the cost of gas into the plant, which in the Cheniere contracts is 1.15 times Henry Hub, plus a liquefaction fee, which is essentially fixed for a 20-year contract, plus a shipping cost. So I've shown the US prices fully built up at $3 Henry Hub, $2 Henry Hub, and 160, which was the price when I put this slide together a few days ago. And then I've shown on the oil index contracts, I've shown two cases, a 14% slope, which is probably the top end of current contracts, the ones that have been negotiated in the last few months, and then an 11% slope, which we're hearing in some contracts. For example, Pakistan, I know it's some way from Northeast Asia, but I think Pakistan has got some contracts, 11%. And what it's really showing is that when a lot of the US contracts were signed between 2011 and 2013, we were right on the right-hand side of this graph. So it's a no-brainer that US LNG looked to be cheap LNG in inverted commas. Of course, now we're on the left-hand side of this graph where US LNG is not competitive with oil indexed LNG. How much that's going to affect decisions by buyers in Asia, what they think about the future of Henry Hub and JCC will determine the credibility or the use they make of these two different prices. But it just shows that what we believed a few years ago, US LNG looks cost competitive, today it doesn't look cost competitive. The oil price collapse will, of course, bring down oil indexed LNG, but it will take time. It takes about 4 months for the full impact of a price change in Brent to feed through into oil index prices in Asia. Firstly, JCC tends to lag Brent by about 5 or 6 weeks, and Brent is effectively an FOB price, JCC is a delivered price. And we can see that in the April JCC, Brent averaged $25, JCC was $46. So it takes a few weeks for Brent to feed through, and then a lot of the contracts link the LNG price to JCC in month N-3. Some of them are an average of N-1, N-2, N-3. So as I say, it'll be August before we see the full effect. When that happens, Brent averaged around $25 a barrel in April. By August, Asian oil indexed LNG prices will be between about $3.35 and $4.10, assuming slopes of 11 to 14%. There are some contracts that have an S-curve. S-curves largely disappeared during the high oil prices in the between about 2004 2010. They came back in some of the contracts negotiated 2010, 2015. I think when we first saw S-curves back in the 1990s, it was the the sellers wanting protection against low oil prices. When they came back 2010, 2015, I think it was more the buyers wanting protection against high oil prices. What we've actually got now is, with low oil prices, that we're seeing the sellers getting some protection. If you've got a reduction in the slope of 3% below $50, at $25, an S-curve would give the seller an extra 75% compared with a straight line. When you look at the prices, 335 to 410, they're going to be quite nice for the buyers compared with what they're paying today and what they were paying last year. But they're still above the futures prices. JKM for August, when I looked yesterday, was 235. NBP was 162, and Henry Hub was $2.06. So the effect of the collapse in oil prices will bring down the the oil index prices, but they'll still look they'll still be at a premium to spot prices if the futures prices are a fair indication. And if you look at US LNG delivered to Northeast Asia on a fully built up basis, so taking into account a $3 liquefaction fee and a $1.70 shipping fee, then the fully built up cost is somewhere between about $6.12 and $7.37. Even on a marginal cost basis, it's $2.92. So it may be competitive on a marginal cost basis against the oil index prices, but it won't be, it'll still be higher than JKM, as I say, if you believe the futures prices. We are, of course, well, the other thing we're seeing, which Pat mentioned in her introduction, is price convergence. The number of conferences I've been to over the years, where one of the questions often asked by the audience is, will we see a convergence of global natural gas and LNG prices? And the answer generally was unlikely. Well, of course, it's happened now. I think really, though, it's happened at $2 rather than the $6, $8, $10 that other people were probably looking for at the time they were asking questions before the current crisis. And they really are very close together, and it's been a fairly steady decline. Henry Hub has stayed round about constant, somewhere just above, well, somewhere between about 160 and $2.50. But we've seen NBP and JKM come down pretty steadily. The other thing to note is the correlation between JKM and NBP or TTF is pretty close, and this is really, I think, LNG driving things in the sense you can transfer cargoes between Europe and Asia based on pricing, based on price differentials. Okay, of course, one thing that the low prices and the convergence of JKM and TTF or NBP with Henry Hub, and even Henry Hub coming to a level above Henry Hub, is that we're now seeing US projects out of the money, even if you treat the shipping costs and the liquefaction fee as a sunk cost. So this graph looks at three cases of the fully built up cost of US LNG using liquefaction fees between $2.25, which is in the Cheniere contract with Shell, and $3.50, which is in the Cheniere contracts with Corpus Christi. Then the hashed line, the dotted line, shows the marginal cost, which recovers 115% of Henry Hub plus the spot freight rate. So between the solid lines and the dotted lines is where selling at JKM prices makes a contribution to fixed costs. Below the dotted line is where it's more economic to cancel cargoes. And the green dot on the graph shows where we are today. And then if we do the same exercise using TTF, looking at the same three US pricing bases, looking as well at the marginal cost by deducting the liquefaction fee and spot and the fully built up cost, the fully built up cost of ships, we get a similar sort of picture of US LNG being at a level in the zone where it's more economic to cancel cargoes. And the green dot here again shows where we are today. And of course, we are seeing cancellations. The figures I saw earlier this month were an estimate of about 57 cargoes cancelled for delivery between May and September. 57 cargoes is around about 4 million tons of LNG. 33 of those cargoes were in June. 33 cargoes, about 2 million tons. To reduce production by 2 million tons in a single month, you need to shut in 24 million tons per annum of liquefaction capacity. I guess we'll start getting information on cancellations for July, because May the 20th was the day where Cheniere's buyers had to cancel if they wanted to avoid paying for the gas supply into the plant. And numbers I've been reading could be 30 to 50 cargoes for July. So we are beginning to see the pricing doing what we might expect, and that is to result in the cancellation of the easiest cargoes, because it's written into the contracts in the US that the buyers have the right to cancel. There's a mechanism for cancelling. It's difficult to say what's happening in Asia in terms of cancellation of oil index contracts. It seems that the buyers have probably been using downward quantity tolerance. We've seen cases of force majeure being declared on on contracts. That's been rejected by the sellers, so that's probably going to end up either negotiation and eventually maybe in arbitration. So we are seeing now the cancellations taking place. Then the contract expiries and price reviews. In addition to any negotiations going on in terms of prices for new supply, there's probably not a lot of those happening, but the buyers and sellers will have to deal with expiring contracts and with price reviews. And in the present environment, you can imagine that most buyers, if they've got an opportunity to review prices, are going to use it. Pat and I talked about this, and we estimate that around 70 million tonnes per annum of long-term contracts will expire between 2020 and 2025. Gas, Petronas, Malaysia LNG, and Nigeria LNG account for about 40% of those. And overall, about 26% of the expiries are for contracts with Middle Eastern producers, 37% with Atlantic Basin, 31% Pacific Basin, and then the portfolio players, Shell, BP, Total, etc., about 6%. There have been some renewables in the last 12 months or so, and a number of price reviews have been concluded. The contracts supplying Europe, mainly Nigeria LNG, have almost certainly agreed prices based on a netback from hub prices in Europe. Some of those contracts originally were oil indexed, but I'm sure that's what they moved on to. Reports on the price reviews and contract extensions for supply to Asian markets appear to have retained oil indexation. I'm not aware of any that have opted for JKM or another form of indexation. There have been changes to the slopes, to the multiplier of JCC or Brent in the contracts, but from what I've seen, those changes are surprisingly small. So I think we're seeing oil indexation continuing, some modifications to the slope, but not as much as might have expected. And I've, as I say, I've not heard of any projects where there's been a move from oil indexation to an index such as JKM. I'm not saying that it hasn't happened, I'm just saying I'm not aware of that happening. And I thought, just to finish off, I'd look at what prices look like in the, if we look at the futures markets for Brent crude oil, for JKM, for Henry Hub, and for NBP. So this slide, I mean, first of all, it shows some optimism that we're going to see prices strengthen by the end of this year. So maybe a lot of optimism that we're going to have a reasonably strong bounce back from the current COVID lockdowns and reductions in economic activity. Henry Hub looks to be somewhere between $2 and $3 over the next the period to 2025. NBP and JKM strengthen, the gap with Henry Hub widens, but they remain in lockstep. The expectation is the correlation between them will continue. And then the top two lines are oil index prices with an 11% slope and a 14% slope. So if you believe or think the futures markets are reasonably showing expectations, then it looks as though oil index pricing will be at the top of the pile against the spot prices. And then the final slide, I put the same prices, oil index prices, and then I showed two cases for US prices on the basis of liquefaction fees of $2.25 and $3.50. And it looks from this, certainly for the next 2 years, that oil indexation will be competitive with US-based LNG. And if you have got a slope down to 11%, then you're probably looking at lower prices right through to 2025. So that's trying to put together as much information as possible and cover it in 30 minutes. Hopefully it adds some knowledge, it adds some information, and creates some points for debate.
Thank you, Andy. And yes, some questions have been coming in. So please, the audience, continue to send us in your questions or even comments or observations that you'd like aired. Andy, I'm going to start with some of the questions coming in. And the first one really is, I appreciate your last two slides just saying, look, we're going to take a snapshot today based on futures prices. But if you layer in your own sort of views on supply-demand dynamics, the question is coming in to say, do you think in the long term that gas prices will be decoupled from crude prices? Or do you think we'll see some shift back so that to buy LNG on an oil-related basis is actually going to continue to be competitive?
Yeah. In Europe, in the Atlantic Basin, they have decoupled, but not entirely decoupled in the sense that if the underlying price of energy is increasing, then all the price increase. But there's a decoupling, and in the States, of course. In Asia, I don't see that happening to any great extent, because we are seeing, as far as I can see, a lot of contracts still being priced against oil. I think what's missing in Asia is a price index which really reflects natural gas supply and demand, LNG and supply and demand in the Asian market. And JKM is sort of getting there, but how much credibility it has over the long term, certainly in terms of spot pricing, it seems to be used quite frequently, but does it yet have the credibility and reliability to price a long-term contract? We're seeing some companies that clearly believe that. Total and Vitol have done contracts with Tellurian, which are JKM linked. So some people believe it, but the buyers, the end users, do seem, as far as I can see, to still be using oil indexation.
And why do you think they still use oil indexation? Is it relevant to their downstream markets, or is it just history and familiarity?
I think familiarity is important. It's something they've been working with since the 1980s. At one time, it looked to be a reasonably steady pricing. You weren't seeing big fluctuations. But of course, the last 20 years have sort of raised questions over that. I think the feeling in the past was with OPEC having a reasonable control over oil prices by increasing and decreasing production, that kept the price or avoided some of the big fluctuations. Of course, I think that theory has gone away in what we've seen over the last few years. I also think, what else do you use? Is JKM reliable enough? I find it very difficult to see Henry Hub pricing being widely used in Asia. I mean, first of all, even before the current situation, what relevance does Henry Hub have to the supply and demand for gas in Shanghai or in Tokyo? Why use an index from a different market? I think as well, this current crisis, the cancellation of cargoes, may raise questions over whether the sharing of risk and reward built into US contracts is fair, because it does seem that the buyers and off-takers are taking more of the risk. And we can see in what's happened, or what's happening. I mean, if 57 cargoes being cancelled by early May, 57 US cargoes, that's $570 million of payments for LNG you don't want. And on top of that, given the fact that the prices in Europe and the prices in Asia were only partially covering the fixed fees, the amount of losses that some of these companies are piling up are enormous. Some of the majors can probably stand that, but some of the off-takers, some of the buyers must be finding a lot of pressure from the amount of money they're having to spend to support the contracts they entered into for US LNG at a time when they look pretty competitive prices.
Thank you. So to go back one step then, in terms of oil indexation for LNG, if I'm hearing you correctly, you're saying it is not broken in Asia. There is actually evidence that some renewals have been done at oil index sort of formulae with slower slopes. But in Europe, the oil indexation is probably starting to be broken and progressively replaced with hub prices or some type of formula around MBP, TTF, or other hubs. Is that correct?
Yeah, so the IGU wholesale price survey, they haven't issued this year's version yet. It should be coming out anytime now, I'm told. But only about 5% of natural gas in Northwest Europe has got some form of oil indexation. And for Europe as a whole, I think it's 25%. So you are seeing oil indexation in the gas market disappearing. And of course, LNG has got to sell in at a competitive price in competition with the existing market prices.
So much gas on gas competition that it's commoditized out to being hub type pricing.
A question which we're not seeing in Asia at the moment. There just isn't any place in Asia yet where there's some real hubs working.
Yes. Well, here's one that I'd like to ask you, because it comes up at virtually every sort of conference where we're talking about pricing. And it's saying, how about using a hybrid of oil, TTF, and JKM? In as much as if you look at all your forward curves, if you don't really know which one to go for, why not go for a blend? But what is your view and pros and cons on that?
Well, if you're a substantial buyer, you can get a hybrid by signing up with different suppliers. Why put it into one contract price? If you've got enough contracts, you can get a mix of contracts which mix of pricing which meet your needs. The other problem I think with hybrid pricing is if you're trying to manage the price risk, it's more complex if you've got two different prices working alongside each other. And I've heard this from some Asian buyers, that the problem with hybrid pricing is hedging, managing price risk is made that more difficult. Now, I suppose for some small importers, then maybe they don't have enough volume to create a portfolio of contracts which reflect the different pricing. But I say for the large buyers in Asia, I would have thought you do that through having different contracts rather than having hybrid pricing.
Okay. You mentioned earlier about what has Henry Hub got to do with the pricing in Shanghai? And of course, we look to China as being part of the recovery, part of the new growth in global LNG going forwards. So are you of the mind that Henry Hub pricing into Asia going forwards is relevant, or is losing its relevance to new buyers who want to contract LNG?
Yeah, when you say new buyers, that sort of adds an extra dimension in. But I think it's losing its appeal. As I say, Henry Hub has got nothing to do with the Asian market, so you're not getting a price that's really reflecting the condition in the Asian markets. When it looked as though US LNG, on the basis of cost of gas plus liquefaction costs plus shipping, was well below the oil index prices. When oil was at $100, if you had a slope of 14%, you're talking about $14, $15 oil indexed, whereas at that time you probably saw Henry Hub around $3. You were looking at $8 for US LNG, and it's a real bargain.
Yeah.
But things don't stay the way you expect, and what's happened recently, even before the cancellations, there are a lot of people must have been making some significant losses against the fully built up cost of US LNG. So I just wonder what the appetite will be as we go forward, whether how many of the buyers are prepared to enter into a contract which effectively gives them all the risk. The risk of paying even they can't take it. The price doesn't move with the market. It's fixed for 20 years. So I think we might see a different attitude towards US LNG in the future.
And of course, the US LNG, as you're saying, is cost plus. It's got a percentage linked to Henry Hub, and then it's got a relatively high fixed cost element. And in your charts, you've shown liquefaction between 225 and 350. I have a question here, sort of referring to, how modern is that relative to today's current tolling costs? Because with the very, very new projects like Venture Global, they are talking about cutting that liquefaction cost down. But nevertheless, it's still quite a sizable chunk, isn't it, of the overall?
Yeah. I mean, Venture Global, I don't think have announced what their liquefaction fees are, but the sort of views I've heard around are that perhaps some of the early ones were below $2, but some of the later ones have been above $2. So they're probably on average a small discount on the 225 Shell is paying Cheniere. So yes, I mean, clearly it helps if you've got a lower liquefaction fee, but it's still pretty substantial. And even at $2, you're looking at what, 6 or 7 million per cargo if you don't take it.
Yes. Yeah, and I think another question that I've got coming in is around JKM, because We have seen in the last few years some sort of meteoric sort of increases in the amount of JKM being traded. And sort of question is, do you see it becoming a sort of deep, liquid sort of market, substantial enough to move people confidently to buy on these spot indexes in the future? Let's say over the next 5 years.
Yes, it depends what you believe. I did some calculations. I think last year the futures trading of JKM gave you a churn factor of about 1. And I think if you look at the first quarter of this year, it's up to about 1.4. I'm not a trader. I've never traded on the markets or anything like that. But the consensus seems to be that you need a churn factor of something like 10 to give you a true liquid, reliable index. So it's got a long way to go to get there. We'll see. I mean, maybe it will happen, but I think it's quite a long way to go before it is seen as having the same liquidity as TTF and Henry Hub and NBP. And I think one of the problems you've got with JKM is that you don't have that many buyers and sellers compared with the US market and the European market. And we refer to it as JKM, and it covers Japan, Korea, China, and Taiwan. But they are separate markets, whereas Europe is effectively one market, and so is the States. So are there enough buyers and sellers to make it a true liquid price?
Mm-hmm. If we go back to US LNG for the moment.
Sorry?
If we go back to US LNG for the moment, before COVID-19 and the sort of genuine event we're in at the moment, we did see some US sellers offering to sell US produced LNG on a different basis to Henry Hub. You had the Shell Next Decade 2 million ton sale, which had a percentage linked to oil, and you had Cheniere, who was modernising contracts by getting upstream producers to accept market netbacks. Do you see, when we start to move out of this current event we're in, more flexibility going to be shown by US sellers towards buyers in Asia and Europe?
I think they're going to have to, if they're going to secure commitments from off-takers or tollers. The real question is, to what extent do a lot of them have the capacity to take more risk? Because we're talking quite a lot of the planned US projects are being run by companies who effectively don't have a balance sheet. I mean, that's why we've seen a lot of these contracts having a liquefaction fee that's fixed and is payable whether or not the cargo is lifted, with the cost of gas as a pass-through. That was the only way the projects could get off the ground. So what does a US project do to offer more flexibility? I mean, one option may be to transfer it to the gas producer, which I think is effectively what Cheniere has done with their contracts with Apache and EOG. But of course, the problem with that is some of the upstream producers are in a worse state than some of the LNG projects in terms of what's happened to their economics. But I suppose a company like Cheniere as well, they've got a large guaranteed, in inverted commas, cash flow from their existing contracts with liquefaction fees backed in most cases by strong companies, creditworthy companies. They might be in a better position to offer more flexibility than a startup which doesn't have any cash flow to back them up.
Mm-hmm.
And one of the problems I think the US project are going to face as well is that there's a lot of competition out there. I mean, there always has been, but if in a world of lower gas demand, if COVID has a longer term effect on economies, Russia and Qatar are probably in a much better position to respond to buyers' needs because they've got much lower costs of production. Russian gas is pretty cheap into the plant. The liquefaction facilities are right on top of the gas fields, so gas gathering is low. The Qataris, of course, have a lot of LPG and condensate being produced with the gas. So they're going to be in, if you're out there looking for new supplies, then I would suggest that some of the other projects, some of the non-US projects, are in a better competitive position than the US projects to meet what will inevitably be additional demands for flexibility, for more innovative pricing, etc., than some of the US projects.
Okay, right. I have lots of questions coming in, and please, everyone who's dialing in, please continue to send in. We'll try and cover as many as we can. So I want to talk about price convergence for a moment. The question of, do you see this as being a temporary thing or fairly structural, given that I think you were saying you think that we're pretty well supplied in the market until the mid-2020s, and isn't it really oversupply that tends to converge prices directly?
Yes, yeah, I mean, there's a bit of a dilemma there because for the existing projects, they can manage to some extent in this current environment. Part of the issue is going to be what new projects, to what extent can they live in an environment of low prices? To what extent can that 500 million tons per annum of planned projects take FID against low prices? So I think when you look at the next few years, you've got about 110 million tons of capacity under construction coming on stream between now and 2026, 27. And I think that's going to meet the demand unless we have a really spectacular bounce back from the current situation. So it looks as though we're in a balanced or oversupply market for the next few years. But if we do have long-term demand growth, and there must be questions over that, given climate change, decarbonisation, and I would suggest that we may be seeing decarbonisation getting something of a boost from what's happened now. I mean, populations seeing how lower energy consumption is cleaning the atmosphere, reducing carbon dioxide emissions, etc.
Yeah.
So if we did see decarbonisation coming up the agenda and governments making promises for 2035 rather than for 2050, do we see an environment where the demand for gas and LNG won't be anywhere near some of the forecasts? And we have forecasts of 600 million tons of demand by 2030 or the early 2030s. I can see a scenario where we're probably under 500 by 2030, 2035, if the anti-fossil fuel lobbies get more support.
Yes, I sort of agree with you, but I think we're going off piste with that.
Okay, sorry.
Supply demand again. So I'm going to bring it back to price. And we're getting lots of questions coming in saying, so what advice would you give to a buyer? You know, would you say buy more spot? Would you say buy Henry Hub to simply diversify some of the pricing to our markets? And should we put S-curves into pricing if we do stick with oil indexation? So maybe just as a skewering effect of taking all those different concepts, what would be your general advice to Asian buyers looking to buy term LNG today in terms of structuring an LNG price formula?
Yeah, I think one thing you've got to look at is what the downstream market is like. You know, is it power generation? Is it a mixture of power gen and and other uses, you know, heating and industry and so on? So I think you've got to look at what they need the LNG for and what they see as the pricing in that market, what's going to drive it. What would you want to go for? I personally would be very nervous if I was in Asia at going for US LNG on the present model. I think it's looking pretty risky. Oil indexation does have the advantage of a link into an energy price, although clearly the gas market is very different from the oil market. If you could get a reasonably low slope in an oil indexation contract, that might be the way to go for it. If your market is very uncertain, if the demand in your market is very uncertain, then probably going for JKM would be a more sensible approach. You could probably get JKM now from projects that are in operation. Whether you could get JKM from new projects is, I think, more questionable. Can you finance an investment against JKM pricing?
Mm-hmm.
So it very much depends on it's a way of dodging the answer or dodging the question, but it seems to me that it's very much depends on the buyer, what the buyer's looking for, what sort of market they're supplying, before you can really answer that question.
And just to expand on that one more direction, is that a question coming in from the audience is, do you just simply have to buy what your competitors are buying so that you stay competitive with them in the downstream market, implying that if some of the largest Asian utilities are sticking with oil and in their renewals and their renegotiations, just changing the indexation factor by a few percent, does that set the tone for what other people will do just to stay relatively competitive?
I think, again, it depends on the market, but certainly I've heard that being given by Japanese buyers. They have to, they can't diverge from everybody else. And that seems to be one reason you're seeing contracts indexed to JLC, the Japanese LNG cocktail, with average prices of LNG imported in Japan. So in a sense, you're guaranteeing you'll be in line with your competitors.
Mm.
It's a strange index to me, because you can only have JLC for part of the market. If it becomes a large part of the market, then it's self-defeating. So that, I think that's the situation in a market like Japan. I suppose in markets where there isn't much competition, like say Taiwan, for the import of LNG, you probably can take a different approach, and we could see that happening, for example, with Thai Power now importing directly rather than buying from CPC. Why can't they pay a different price from CPC? So I think it's going to depend on the market, but I think it's a good point that you don't want to diverge too far away from your competitors.
So we've had a real seismic effect here on supply and demand for global LNG. We've seen oil prices, fall from $60 a barrel to sort of around 20. We've seen Henry Hub move up. We've seen spot market prices fall below Henry Hub levels. But through all of that, what do you think the winners and the losers are in terms of price indexation? Do you think oil indexation is weathering the storm, and that the rationale to keep it isn't broken and we're going to carry on with it over the next 5 years?
Yes, I think that's probably a summary. I mean, it should be broken in many ways. Why are you linking your LNG price to a fuel which really is a transport fuel? 57% of oil is used in the transport sector. So it should be broken, but I think because there isn't any obvious replacement, it'll continue.
And the question I've got coming in from the audience again is sort of saying, let's say that it does continue, take that hypothesis saying it does continue. We've got a lot of oversupply, we've got a lot of recontracting by companies like Gas, Petronas, etc. Do you see sellers lowering the slope significantly but keeping oil indexation? And when I say significantly, I mean way below 10%.
Not yet, from the information I've seen. You would have thought that for suppliers who've been supplying for 20 years, fully amortized their investment, then they could be more competitive. But it doesn't seem to be happening in terms, I mean, I think the slopes have come down, but not, I haven't heard any below 10% yet. It doesn't mean they haven't happened. I just haven't heard any that low. I mean, the lowest I've heard is around about 11 and a half.
Okay, and one last question just on market liquidity that's coming in around Singapore and Malaysia wanting to be LNG trading hubs. Do you foresee in the next 5 years an opportunity for either of those countries to become a trading hub, or do you think the problems we've got today are going to persist with low amounts of liquidity?
Well, I mean, Singapore was hoping it would become a trading hub, a paper trading hub. They tried with the Singapore LNG index, which didn't really get any takers. And as a physical hub, we've seen a little bit about a trading around Singapore with cargoes being reloaded, but it's relatively small. I mean, that terminal is working well below capacity. So at the moment, there doesn't seem to be much of an appetite for that. Perhaps that will change as we come out of this current crisis into what undoubtedly would be a very different market to the one we went into it with.
Okay, and one last question, which has come in about sort of shipping costs as well, which again are quite volatile, but at the moment, trending down. That they're saying, do you see that the prices between the Atlantic Basin and the Asia Pacific Basin will be a lot more linked to the differentials in freight over the next 5 years, rather than big arbitrages, which we've seen in the past?
Oh, that's a difficult one to finish off with. The shipping costs are still, the differentials are relatively small. Well, let me get the differential between if you've got a $70,000 charter, I think the cost of the shipping is about 50-60 cents difference between Asia and Europe. So you don't make a massive difference to the arbitrage, I don't think. It'll certainly be a factor, and I'm sure that managing your shipping costs and getting them down to cope with the situation is going to become increasingly important. I've been surprised at the length some of the voyages are taking, and it strikes me that there there is an opportunity to reduce the cost, but I'm not sure that it's going to have a big impact on the differential between Europe and Asia.
And one last question on the shipping rates. When you look at the sort of supply demand sort of forecasts in the short term, do you think that overall we are now relatively long shipping and that shipping rates will fall, which will put further pressure on market prices?
Yes, yes, I'm sure that's going to happen. I think one thing that's holding shipping rates up at the moment, they're still not great. I think you're looking at what, 25, 30,000 for a steam-driven ship, 30, 35 for a diesel ship, which are not much more than covering operating costs. But what's holding them up, with demand going down, is quite a lot of ships are being effectively used as floating storage or slow steaming. We haven't really seen much of an impact on demand as yet. In the first quarter, demand for LNG grew by about 12%. In April, it was about the same as last year. With all these US cancellations, one would assume that's going to throw more shipping into the market. Floating storage may take up some of that excess, but I would have thought there's going to be downside pressure on shipping rates, certainly over the summer months. Maybe they'll pick up in winter, especially if you look at the futures market, where winter prices are $4 or $5 for JKM compared with $2 now.
Okay, so if I can just attempt to summarize what I think I heard from some of your answers to these 4 big bullet points that we came out with, it was that there is still a rationale for oil indexation in term LNG, particularly in Asia. In Europe, that oil rationale is probably lost, and that progressively we are moving over to much more gas-on-gas competition and using hub prices. But in Asia, I think you're saying that it isn't broken at the moment, despite the whole turmoil that the market has been in. And partly that is due to familiarity, and partly it's due to it representing an energy cost in those consumer markets, and it's hedgeable. And in fact, things have got to change quite a lot in terms of liquidity to offer an alternative. Would that be a sort of a summary?
That's fair, yeah.
On bullet point number 2, about buyers' appetites to buy on Henry Hub, I think you actually answered the question or gave us some insights which went beyond just Henry Hub pricing, but actually talked about the Henry Hub sort of business model and the risks that it puts overall on buyers, which is a Henry Hub index, which probably isn't relevant to their downstream markets, particularly in Asia, but also with this large fixed element in the price construction as well, and the fact that buyer takes quite a lot of risk, and that's a project financing requirement. And I think you were saying that that model probably is broken as it is, but what we are seeing from prospective projects is some way of perhaps all changing the bargain, what they're offering in terms of offering some oil indexation or some market-related JKM pricing. And I think you mentioned Tellurian in that regard, with Total and Vitol selling some of the Tellurian volumes on a JKM. For JKM, I think you also said that there's been a lot of growth, but there's still a lot more to happen in order for it to reach some level of liquidity. And I tried to sort of push you a bit on the sort of timing of that. I know it's really impossible to say, but directionally it's going in a positive direction, isn't it? We are seeing more and more trade.
Yeah, with a long way to go.
With a long way to go. On the issue of price convergence, yes, we've got this sort of price convergence at the moment, and I think you're saying it's structural whilst there's oversupply, because there is no need to have an assigned high premium to a particular market if markets are all saturated. So whilst you've got an oversupply, probably you do have this convergence. So lack of arbitrage opportunities. It's only really if Asia starts to go short that you'd get a positive premium again. And then you brought into the whole debate this issue about energy transitions, and that becomes so complicated then as what the whole demand equation is. So I think we'll draw a line on that at the moment. But on the last one, the last bullet point about the recontracting, I think you said there that there's a lot of recontracting to be done in the next 5 years of something like 70 million tonnes of existing contracts. A lot of that, I think over 90% of that is currently on oil indexation to Asia. And I think from what you're saying, it could very well be resold, perhaps in new, more modern ways, but still largely on an oil index. Is that what you said?
Yeah, I mean, certainly that's what's happening now.
Right.
You would have thought there's more scope to look at alternatives if you're recontracting, but not much evidence from what I've seen that that's happening.
Yes, and then I think lastly, just to sort of sum up, your advice to buyers, which I think is always the advice I like to give them as well, is try to be relevant on buying LNG to the market you're selling into and the market sector. So if your downstream market is geared off of oil prices, or a lot of your competitors are selling off of oil prices, then an oil indexation has got some relevance. If it's not, then certainly choose something else. A lot of questions that we've had, Andy, are really from the buyer side, I would say, of the market, just saying, what's your advice to us? Buy term, buy spot? If we buy term, should we buy it on a spot-related price? Do you want to give us just one or two parting comments? What your advice to buyers would be right now?
It's difficult. I mean, I tried to cover it earlier. I say it is thinking through the risks you're taking, both in terms of buying and selling regasified LNG into the market and trying to get those as close to each other as possible. So again, it's very much about your downstream market and what is going to give you a reasonable amount of certainty that you can on-sell your regasified LNG without making a loss.
Okay, well, I think we've sort of run over time by about 10 minutes or so, but that's partly because we've just had such a lot of questions coming in, and I wanted to try and cover as many of them as I could. But ladies and gentlemen, thank you so much for both joining into this webinar and staying with us. There's still a very large number of people on the line, so thank you very much for that. I hope you have enjoyed it. Some people are already saying, Andy, it was worth them staying up late. So
nobody's ever said that to me before.
Right. But thank you very much, because a lot of these questions are literally ad hoc. They're things that are coming in. So you're just getting the real-time sort of questions there. So thank you very much, Andy. And ladies and gentlemen, do keep on looking at lnghub.biz for more of our podcasts, our webinars, and send us in any ideas if there are particular topics that you would like us to cover. But let me just finish by saying thank you very much, Andy. That was great. And thank you for all the effort you put in making the slides. Thank you. And goodbye to everybody. Stay safe. We'll see you soon.